Welcome to Module 4 of Accounting for Managers. In this module, we'll explore Cost Volume Profit Analysis, or CVP analysis. While the financial reports we've studied in previous modules provide an overview of a company's performance, managers often need additional tools to make informed operational decisions. CVP analysis helps us understand how costs, volume, and pricing interact to impact a company's profitability. Whether you're preparing this type of analysis yourself or interpreting its results, mastering these concepts is essential to becoming an effective manager. By the end of this module, you will understand cost classification and its role in decision-making, calculate and interpret the contribution margin to analyze profitability, determine the break-even point for products or services, use sensitivity analysis to evaluate how changes in costs, volume, or pricing impact profits, assess pricing alternatives to maximize profitability. In previous modules, we focused on understanding financial statements and analyzing company performance. Module 4 builds on this foundation by diving into tools that managers can use to make real-time decisions about costs, pricing, and profitability. This analysis moves beyond looking at past performance and equips you to forecast outcomes and make proactive changes to improve operational efficiency. CVP analysis is a decision-making tool that examines how changes in costs, sales volume, and pricing affect a company's profits. It's particularly useful for answering questions like, how many units do we need to sell to cover our costs? What happens if we lower our prices? And how will changes in fixed or variable costs impact profitability? Let's consider a real-world example. Imagine a coffee shop owner wants to understand how many cups of coffee they need to sell each month to cover their fixed costs, such as rent and wages, and still generate a profit. If fixed costs are $3,000 per month and the contribution margin per cup is $2, they would need to sell 1,500 cups to break even. This type of analysis helps managers make informed decisions about pricing, marketing, and production. Costs are classified into three main categories: fixed costs, costs that do not change with production volume, such as rent and salaries; variable costs, costs that fluctuate based on production volume, like raw materials and utilities; mixed costs, costs that contain both fixed and variable components, such as electricity bills with a base charge plus usage fees. For example, a manufacturer pays $10,000 in fixed rent and $5 per unit in variable raw material costs. If the company produces 2,000 units, the total cost includes $10,000 in fixed costs and $10,000 in variable costs. Identifying and understanding these costs allows for better budgeting and decision-making. The contribution margin represents the amount remaining after variable costs are subtracted from sales revenue. This margin covers fixed costs and contributes to profit. The formula is contribution margin equals sales revenue minus variable costs. For example, a bakery sells cookies for $3 each, with variable costs of $1. If the fixed costs are $3,000 per month, the bakery must sell 1,500 cookies to cover costs. Understanding contribution margins helps businesses determine pricing and profitability goals. Break-even analysis determines the sales volume needed for a company's revenue to equal its total costs, meaning there's no profit or loss. The formula is break-even sales volume equals fixed costs divided by contribution margin per unit. Let's consider a yoga studio. The studio charges $20 per class and has fixed monthly costs of $5,000. Each class costs $10 in variable expenses. The contribution margin per class is $10, so the break-even sales volume is $5,000 divided by $10, or 500 classes. This means the studio needs 500 attendees per month to cover its costs. Sensitivity analysis evaluates how changes in costs, volume, or pricing affect profitability. It's particularly useful for preparing for scenarios like cost increases or pricing adjustments. Managers can use this tool to assess the potential risks and rewards of operational changes. For example, a clothing retailer might use sensitivity analysis to evaluate the impact of a 10% increase in fabric costs on its break-even point. If fabric costs rise, the contribution margin per product decreases, requiring the retailer to sell more units to maintain profitability. This type of analysis helps managers anticipate and respond to challenges. Pricing decisions are another key area of CVP analysis. Managers must evaluate different pricing strategies to balance revenue and profit. Common strategies include penetration pricing, setting low prices to attract customers and increase market share; value-based pricing, setting prices based on perceived customer value rather than costs. Consider a streaming service like Netflix. If Netflix raises its monthly subscription fee, sensitivity analysis can help predict how this change might affect subscriber retention. While higher prices could increase revenue, they might also lead to cancellations. Managers must weigh these trade-offs to make informed pricing decisions. To summarize, CVP analysis examines the relationships between costs, sales volume, and pricing to evaluate profitability. Key tools like contribution margin, break-even analysis, and sensitivity analysis provide managers with actionable insights for decision-making. Cost classification helps managers understand how different types of costs behave. Pricing strategies and sensitivity analysis allow managers to make proactive changes that optimize profitability. Mastering these tools is critical for driving the success of any organization. In our next module, we'll focus on evaluating budgets for decision-making. Budgets are essential for forecasting and controlling financial performance. You'll learn how to prepare and analyze budgets to align with organizational goals. See you next week.